Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for March 29th, 2021. Please see our disclaimer for important information. Well, as we have been for the last year, just about, we've been starting the chart packs here with kind of an update on the coronavirus situation. And here is our handy, trusty chart with our 7-day moving averages for both daily new positives as well as daily new deaths. And as we inoculate more people here in the U.S., we would certainly expect to see the daily deaths move down, which we have. Daily new positives seems to have flatlined just a little bit here in the last couple of weeks, and some of that probably has to do with the fact that we've got states like Mississippi and here in Texas. We've opened the economy. We've rescinded our mask mandate, although a lot of businesses here in Texas, especially here in our local area, are continuing to require masks. But nevertheless, we're seeing kind of a flatlining in new cases. But as you'll see, that we are making a tremendous amount of progress on inoculations of our population. Here's a quick update on vaccinations by vaccine type. And so obviously we know that the Pfizer, BioNTech, and Moderna have been out there for a while. These are the 2-shot doses. So together, we're well over 120 million of those vaccinations. And then J&J, which was just released or approved for EUA not too long ago, now we're up to 2.6 million doses, and that represents essentially 2.6 million people that have been inoculated, because that's only a 1-shot protocol instead of a 2-shot protocol. So all told, we are at 130 million total doses administered. So we're getting there. We're making progress towards this goal of herd immunity. This, I thought, was an interesting update provided to us by First Trust Advisors from data that comes to us from CDC. And so it looks at the age cohorts. And very importantly, we want to look at the age 65-74 cohort, as well as the above age 75 cohort. And you can see here, I think, by and large, we're 2/3 of that population, the highest and most at-risk population cohort of all of the U.S. population has been vaccinated to date. And so we're making progress on the 50 to 64, and a lot of states now not only are at 50 plus on eligibility, but they've also opened it up to essentially all people of the age of majority in a lot of states, not all states, but certainly some of the more populous states. And we should expect to see those lower age cohorts begin to move higher now that they're eligible in many parts across the country. Here's our path to immunity chart, and as we've shown you in charts of the week past, the green part of this chart continues to increase as more people are inoculated. And this is, we've been telling you for quite a while that at some point the green is going to absolutely dominate this chart. So blue represents people that have had the virus. The gray area represents, according to the CDC's estimate, that for every person who has been infected, there have been 4 others who have been infected and just didn't know it. And then as a result of that type of infection, where they're asymptomatic, then they do possess the antibodies. So this is kind of this pathway to herd immunity, if you will. And even though the orange line of best fit here seems to indicate that we're approaching 70%, obviously we've got new variants, new strains that are coming of age. We've got the 117 Britain strain. We have the strain coming from South Africa. And we know, obviously, that other parts of the world are not inoculating at the same rate that we are. And so being behind, I think it's fair to say that that there are folks that have been vaccinated that might be perhaps carriers of the new strains and not even know it. So we still need to remain vigilant for the time being, but it's clear that we can begin to open the economy a little bit more. Here's an interesting chart also from First Trust that shows us reported COVID-19 cases by region. And so this is just a glimpse of the U.S. And what this represents is basically the number of weeks from the instance where we had one case per 100,000 people. And so when you think about that, we know it was last spring. And so we're a year plus into this. And so if you look towards the right-hand side of the chart, we're well past like 365 days. We're kind of into that 13th month, if you will. Obviously, we had in the end of last year, we had that really high surge concerned a lot of us, and so we had in many parts of the country, the spike in cases, but that's really fallen off. And what's interesting here is in the U.S. Northeast seems to kind of hold at a higher level per 100,000 population, and it actually kind of spiked up here lately. Rest of the country seems to kind of, have fallen or maybe even, flatten out, if you will. Midwest, we've had a little bit of an uptick in the last couple of weeks, but basically, if you look at the southern part of the U.S. As well as the western U.S., we've had a continued decline in the number of cases in those particular regions. Here's our high frequency data, and as we've mentioned last week and alluded to in the week prior to that, most of the high frequency data is actually pretty good. Especially if you look at over the last month, as some of the areas have been reopened. I mean, in Texas, obviously, as I just mentioned, we had a rescission of the mask mandate, and we've had some increase in capacity loads for a lot of our businesses. Again, with the idea that a lot of people are still using masks and being responsible, but we've had a clear uptick in the data. Not only do we have increase in the sales of gasoline, TSA checkpoint data is up significantly in the last month, and then open table reservations for the restaurant industry, and we've got another very specific slide on that. RevPAR, hotel revenue per available room in the hospitality industry, all looking really strong. And if you move up the scale, I mean, the employment picture looks a little bit better. We still have a ways to go on the employment side, and we'll talk about labor in a second. But when you think about box office receipts, we're beginning to see more movies that are coming that are being introduced in theaters as opposed to streaming first, and that's really good for that industry. And I think it's good for the psychology of the consumer to feel like, okay, they can go to a theater and watch a movie in a safe environment, et cetera. And even though we've had a little bit of a backtrack in terms of shipments, railcar traffic, steel production, those types of things, those are net positive over the last month, which is, again, kind of establishing a fairly decent, consistent positive trend. Here's a chart that I mentioned on restaurant diners and payrolls from Refinitiv and Open Table. It's really more Open Table data that kind of floods into that high frequency number that we just showed you. But again, you can see the clear uptick as we enter kind of the true spring months here. Now that we've officially transitioned into spring from winter, you can see that number moving higher. We've got obviously higher in-person restaurant diners, which is really positive for that particular part of the industry. And then, something else that we've been very concerned with for a while is payrolls. Now, we're not back up to where we were in terms of, frankly, both of these metrics, but they're moving in the right direction, which is very, very encouraging in my opinion. Here's a chart from Oxford Economics. It's basically a recovery tracker. And so these are indicators in these various colored areas, whether it be health, production demand or consumer demand, employment, and overall production, mobility, financial. These are all kind of indicators that Oxford has put together to kind of give us a sense of where we are as an economy. We're not back where we were, just kind of like we saw in that last chart with regard to open table and payrolls, but we're getting there. So now we took a backtrack. We looked like we were making progress. September, we had that really violent wave of new cases and kind of the renewed shutdowns and things like that. Again, this is just for the U.S. We know that other parts of the world, particularly in Europe, I mean, there are lockdowns and things like that that we're not experiencing here in the U.S. And so clearly now, as we've transitioned past, that January bubble and exited winter, that we're on an uptrend on a lot of these areas. Wanted to show you a confidence indicator from Vistage, which I happen to be a member of, but also Vistage is a CEO peer advisory board group. It's a national organization and has many, essentially thousands of members across the country, and so they poll their members, and confidence levels are actually pretty high and much higher than GDP at this point. So, you figure, from the perspective of the CEO who understands their business, understands their operating environment, understands their constraints that hold back their ability to achieve their objectives, with all those things in mind, their optimism is actually very high. And so I take this as a tremendous positive. And if you look at the relationship between GDP and confidence, it really gives you some sense of relief in one sense that GDP has room to grow, and in another sense, it kind of almost alarms you the fact that we've had such a strong response in CEO confidence, but we haven't had that bounce back in GDP yet. And I think we probably are going to see that here. Perhaps not, maybe not so much in the first quarter, but in the second quarter as we deploy the fiscal stimulus from this program, and we begin to, perhaps if we have another $3 trillion infrastructure program or anything, any facsimile of that, it's clearly going to have a really strong response in 3-month growth that I think will bring these two lines or these two data series in line. This is data from Citigroup. This is their economic surprise index as well as the hard data that serves as kind of an input into that index. And if you look at this chart, I mean, it seems to, provide a kind of a pessimistic view as far as the total economic situation is concerned. And I'll give you that, but I want to caution you that this data really represents that period that was defined by the polar vortex shutdowns, Texas being a huge contributor to overall national GDP, and a lot of those states along the southern border, as well as states that were north of Texas that also experienced some shutdowns. You talk about semiconductor industry, you talked about petroleum, you talked about a lot of different areas that were impacted by that polar vortex. And this is reflected in the data points that we're just now seeing that come to us at roughly a 30 to 45 day lag. And so I wouldn't worry too much about the downtick in this area because I see so many other data points that are positive in this, but I thought it was interesting to share that we've seen this downtick, but not to get overly concerned about it. Well, in somewhat of an offset to the last chart that we showed you, I want to show you this data from the Kansas City Fed. And so this data is actually very positive. So their manufacturing index, again, it represents a minority component of our overall economy, but it's nevertheless important to sentiment and to a lot of other things. And it's a very strong indicator of where the economy is heading. That number is very strong and continues to go higher. So this flies in the face of some of the economic surprise index. And this is why I want you to kind of look past that economic surprise index that kind of reflected some of the hiccup that we had from the polar vortex and kind of look at the bigger picture to say, listen, the backdrop is actually pretty positive. New orders going higher. In fact, it's been some of the best overall survey data that we've seen in new orders in years. So I feel like that's a very good positive at this juncture. All right, well, let's talk about something that could serve as kind of the fly in the ointment here for, all of the good things that we see going on in the economy. And frankly, it's the choke points in the production system. And so, in these charts, you've got extended delivery times. The lower the number, the more of a choke point that manufacturers are finding in their supply chain. And then on the right-hand side, you've got backlogs that are moving higher of work. And so there's a lot of choke points that are in the system, notwithstanding what's going on in the semiconductor area. And we know that Samsung, who's a major supplier of chips into a lot of different areas, 50% of their U.S. production was idle because of the polar vortex. And then we have a lot of clogs in our port system, the port of LA. There's a lot of essentially container ships that are at anchor waiting to be processed. We've got choke points in the Suez Canal right now with a stranded container ship that they're trying to basically free from having been grounded in the Suez Canal. That's causing a huge bottleneck now. But we see essentially a situation where demand has picked up much faster for manufactured goods than the manufacturing industry ever thought it would. So as many plants were idled because of COVID and shut down, there was a huge demand for durable goods that kind of picked up before a lot of these plants could open, and certainly open at a capacity level that would service this demand. And so we're seeing these clogs right now. And so I think what the implications are is that even though the backdrop is extremely favorable for stronger economic growth, these types of choke points could put an inhibitor on that, or maybe a governor to the speed at which we can recover. Another thing that we need to understand, and we've talked about this a lot, is the inflationary impact of kind of production level cost inputs. And we see here input prices on the market U.S. services PMI continuing to move higher. We see prices charged actually moving higher. Now, there was a reluctance for a while in wanting to pass those higher costs on to consumers, but then it's now happening. And so what we're seeing in the data, and it's very clear in these two charts, is that we've got producer level inflation that's hitting the pipeline and in fact being passed on to consumers. So this is really the kind of the initial tangible evidence of this inflation that we've been talking about for some time. Now, switching gears here on the labor market, this I take as an extremely positive chart. It's Google Trends. It's produced by Arbor. And basically what it shows you is that in these areas, these various segments, whether it be, job listings or actual job openings and whatnot, you get to see, the searches. And these are, from Google Trends and basically inputs and searches in Google, that you can see that there's a lot of interest in activity. Job seekers are getting more active. This is all very good. And obviously you have to have jobs for job seekers. But the fact that you've got enthusiasm over getting back into the labor market, I think is a really positive sign here. We'll talk about commodities for a second. So this is the commodity index from Bloomberg. And so you can see here, the actual data is the index price, which now is about 83 or so. And as we head into April, now the 200-day moving average is also something that's relevant here in the fact that we've broken through that actually many months ago. We continue to trend much higher, and it's pulling that 200-day moving average. So overall commodity prices, again, that's a huge basket. Industrial metals, soft goods, like sugar, we've got some charts on that coming up. and everything from hogs to sugar to industrial metals. The overall commodity basket is perking up and it's remaining at a fairly high level. Here's two things which have kind of moved in different ways here over the last 6 months or so. I mean, gold had a really strong year last year, and it's really kind of struggled this year as we've seen some changes in the interest rate regime. We've seen a reduction in the net negative real interest rate, which has been contributing to gold's rise last year. But on the right-hand side, you clearly see that we've broken back through that 200-day moving average at 1740-ish level. And so, gold with interest rates rising, again, we haven't seen the inflation side, and usually gold is a decent hedge for that. But we've just seen an interest rate normalization where some of the other asset classes, like even fixed income, floating rate fixed income, has become more attractive, and it's taken some of the steam out of gold. Now, on the left-hand side is the crude oil price per barrel, and that's been, again, a tale of kind of two cities here. So last year, oil was really challenged, and gold was high. This year so far, oil has really moved higher, and it showed some strength. And we've got we've been watching rig counts, we've been, watching activity and production levels, and we've got a chart on that coming up. Just a really encouraging backdrop there, notwithstanding what's going on with OPEC Plus or et cetera. But a strong backdrop there. But in gold, we're definitely seeing some weakness there, which I think could persist for some time. This is crude production. So we've now kind of reattained our pre-polar vortex levels. So again, we're below where we were at the end of 2019, heading into 2020, but we've regained some of these lost areas. And I think this is, what's interesting in this is that we have a lot of relative strength in crude prices, even though we've kind of found a landing spot, if you will, for overall production levels. And I think one would reason that if we increase our production from here at $60 a barrel, it becomes more profitable for these marginal producers to bring production back online, that you might see that production number move higher. Maybe that provides a little bit of a dampening effect for crude oil moving much higher from here, but it does help the overall economy, and I think it does certainly help the energy sector, to have some kind of a staying power here at the $60 per barrel level. Here's a couple other sectors that wanted to mention, which we've been monitoring now. Obviously, cotton apparel has taken it on the chin, but cotton prices have moved higher. And then sugar, I mean, it's a very similar looking chart, and you can see how it's rolled over kind of from mid-February on. And some of this has to, do with production levels. Some of it has to do with weather. Some of it has to do, frankly, with demand. But we've seen kind of a leveling off and kind of I'll call it a normalization in prices. So we don't have this kind of inflation inputs that we had just literally a couple of months ago. But it's actually pretty interesting to watch how, to what degree that we've seen this recent softness in prices. And in a similar way, we look at wheat. Wheat prices have gone down, but conversely, we see hog futures move higher. So there are clearly some puts and takes in this whole commodity basket. Overall, commodities are continuing to move higher. I think, but we've seen the changing of the guard over the last couple of months, and it's clearly not the commodity basket and kind of the inputs and the impetus behind commodity prices that we saw just a couple of months ago. That much is clear in just literally these last two charts. So we've seen multiple areas of the market, of the commodity basket, witness erosion here. Quick comment about labor. So these, I thought this was really interesting. And this is Labor Department data that's been reprinted in the New York Times. And then, basically, if you look at weekly jobless claims, I mean, there have been puts and takes, as we moved into 2021, and we saw a little bit of erosion at the end of last year, but we're seeing some really clear traction now in the labor market insofar as new weekly jobless claims are concerned. In fact, we're at the lowest level since the beginning of the pandemic, even though we're much higher than we were prior, I'll call it pre-pandemic. But we're trending in the right direction, and that's really positive for a lot of different reasons, for consumer spending, consumer sentiment, and I think it's positive also from the standpoint of perhaps bringing people that are out of the labor market back into the labor market, that they feel a little bit more confident, that there's opportunity. So I think you could see labor participation pick up at the same time that you see job openings begin to expand. And so that will get people back into the labor pool and also help to move consumption forward. Now, on the flip side, housing affordability is becoming a bit of an issue. We know that there are price challenges in many markets of the country, and with this inflation input that's coming through the production channel, we can clearly see inflation expectations moving higher, and also as a result, moving the 10-year Treasury higher, which is a benchmark yield on which the 30-year fixed rate mortgage is indexed to, or is indexed. And you can see clearly in this chart that the 30-year fixed rate mortgage rate is moving higher. And I think it could easily, attain 3.5%, maybe even 3.75. I think that's the 3.75 figure would be predicated on a 10-year Treasury rate moving closer to 2%. Certainly has the ability to do that, but I think there's going to be maybe some governors to that. I think the Fed's going to get a lot more interested in managing interest rates if we see a 2% 10-year Treasury. But clearly, the affordability argument that was being made last year, even though prices were moving higher, interest rates were really, really low. Well, here in this chart, that tells you that interest rates are moving higher, and so it's not as affordable, and certainly not as much of an offset coming from mortgage rates that we had last year. I thought this was interesting from the National Association of Realtors survey, and this just tells you that there's a lot of competition for housing. I think you probably talk to any real estate broker, and they would agree with this chart that you're getting multiple backups for every sold property. You're getting multiple offers. I mean, the rate of offers is moving higher. It's a function of supply and demand. There's not enough supply, and we've got a lot of mobility. And I think a lot of mobility as maybe millennials are moving into larger dwellings, and we've also got a lot of Gen Xers that are now beginning to seek housing. And so you've got more demand than the supply can fulfill right now. And as a result, you get this chart, which shows you that there's more competition for each property on the market. So I wanted to show this one as well. This is also from the National Association of Realtors, and this one really caught my eye. And so basically the blue line represents current new and existing homes for sale on a 1-month lag, basically. And then the kind of the yellowish gold line is the estimate of required homes to achieve a 6-month supply. And that's important because 6 months of supply is kind of universally accepted as kind of that equilibrium point, that evidences a stable real estate, single family residential market. And so, if you believe this chart, and this is the NAR's own analysis reflected here, that we're like multiple millions of home units short of being able to achieve 6 months of supply. And so, what this is doing is putting pressure on builders to build more, is putting pressure on jurisdictions to permit more residential, which is something we face almost on a bi-weekly basis here in the Cedar Park City Council, is getting more housing units on the market. And clearly that's something. It's not just a local phenomenon, but it's a national issue. And you can see in that blue line that new and existing homes for sale continues to trend lower, and it has for many years. And so what's clear in this slide is that home builders have been struggling to actually keep up with this demand. So here's a chart that comes to us from Deutsche Bank, and with data also supplemented by Bloomberg, that it shows you that as we head into the last half of this year, head into 2022, that we have break-even inflation rates that are indicating, in fact, that we're going to be exceeding that 2% target that the Federal Reserve has put out there as a trigger point for or at which they'll become more interested in the whole short-term interest rate equation. This having inflation that would exceed 2% for an extended period of time would be that point at which they would become more motivated to want to increase short-term rates. And it looks like in this analysis here that the implied break-evens, the implied inflation here is going to exceed that 2% target really almost in the next, I'll call it, 6 to 12 months. And so that's a very interesting analysis because right now the expectation is the Fed's not going to be moving until 2023. But if we see this type of inflation manifest, it could very well be something that we see, i.e. the Fed raising short-term interest rates, perhaps here in the next year. Well, a quick note on China. So, I'm reading a lot on China right now, and obviously it was the only area or country, if you will, in the world that posted positive growth last year amidst the pandemic. A lot has been made about China. On the left-hand side, you see business confidence index is extremely high in China right now. But what I thought was really interesting coming out of Bloomberg was the defaults onshore of corporate bonds have really spiked lately. So, in some respects, I kind of look at this as maybe a paper tiger, that we're seeing a lot of optimism. We're seeing a lot of news. We're seeing a lot of buzz out of China. China's doing well, blah, 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 blah. But there are some issues that kind of underlie that growth that I think are really evidenced in the right-hand side of this chart. That it's not as strong and as robust as everyone thinks. And so, again, if you kind of look at the tea leaves over the next several years, it may not be as evident that China is going to be in the leadership position that it would seem to indicate now. And perhaps the U.S. is going to have be in a better relative position here as we look out into maybe 2023, 2024. Quick look at sentiment here. We've got the American Association of Individual Investors, U.S. Sentiment Indicator. No surprise here. This has remained in positive territory for quite a while. So investors are extremely bullish right now. Market continues to go up. We've had a little bit of volatility, which at one point did cause that number to kind of come back to the baseline. But this is a diffusion index, so anything in a positive realm indicates bullishness. And so we are extremely bullish right now as individual investors, and as we've talked about with not only GameStop and some of these other stocks where some of the individual investors have kind of flexed their muscle against the institutions, we clearly see more of an influence on stock behavior from individual investors. And so looking at this, that would seem to be bullish for continued market outperformance. Quick note on SPACs. These are special purpose acquisition companies. So these are what they call blank check companies. And so a lot of these go public, raise a bunch of money on the hopes and the promise that they'll go make acquisitions, which will get spun out into their own publicly traded entity. And that's why these companies exist. They're not operating companies, they're just acquisition vehicles that raise a bunch of money from individual investors and then they go buy companies basically. And what's really interesting is that last year we thought we had we did in fact have a phenomenal year of this type of activity, but so far in not even 3 months of 2021, we've had an explosion in the number of SPACs, and at the same time that we've seen the number of SPACs that have come to market to raise money to go buy companies, we've also had a lot of speculation in these SPACs. And so, if you look at the right-hand side of this particular graphic, you can see how much that SPAC index has underperformed. So, it used to be the great hope that you go buy an IPO of a new company on the speculative thought that you would be able to sell it in pretty short order for a lot more than you paid for it. Well, the same thing applies to SPACs, except the value proposition has gone completely the other way, and a lot of investors, I should say, have really lost their shirt on these SPACs as of late. Something else I've been paying attention to is companies have, as I've mentioned many times here over the last 6 months, have raised a lot of cash. They've improved their balance sheets. They've got a lot of cash and liquidity. Now, in 2021, as we expected, they'd be deploying it more. They'd be raising dividends. They're getting more cash off the books and into the economy, I'll call it. Now, what's interesting here is that buyback, stock buyback, as a mechanism of getting liquidity back to shareholders, has actually played out extremely well over, I'll call it the last 6 to 9 months, especially the last 6 months. But what's really interesting here is that for all of the spike in stock buybacks, it's actually been relatively concentrated in tech, financials, consumer discretionary, and healthcare. All the other GIC sectors of the economy really haven't participated. And so we've seen a lot of tech companies that are already flush put a lot of money to invest into reacquiring their own stock. Yeah, I've been watching Bitcoin for some time. I think in most experts' opinion, it's not ready to become a reserve type currency. It's not really ready to attain a true currency status because of the volatility. You can see at the top hand side, the net asset value and the trust price for the GBTC, which is a tracking stock for Bitcoin, has just gone through the roof. It's just been crazy. But at the same time, what's interesting is that a lot of these tracking stocks are also volatile in themselves, and volatile from the standpoint of this one in particular, trading significantly below its net asset value, which is actually pretty interesting here. It just shows you the degree to which Bitcoin itself and cryptocurrencies are volatile, and they're just simply not ready to take the reign of being defined as a currency. I'd say that they're very much an asset right now. They're a speculative asset. A lot of people have made good money in Bitcoin, and I'd say more power to you. But in terms of how Bitcoin and cryptocurrencies are being defined right now, it's still very much an asset and very much not a currency type definition. High yield credit spreads. Really interesting here. There's I'll call it a reasonable positive relationship between these two. Now, global M&A value is in this red here, and so we've seen a huge spike in this over the last 18 months. Again, this is, basically putting high yield credit spreads at a lag, and we've seen really, really tight credit spreads. I mean, people have really struggled to find yield in this market because high yield is basically not pricing in hardly any risk right now. There's certainly not a risk of a recession, not a risk of a credit default cycle spike, none of that. But yet we see global M&A really pick up here. And what's interesting in this is it would seem to imply that here in the coming months that we'll see an expansion in spread, meaning prices for high yield will go down in response to this. And so I don't really have any inferences to make now, but I think it will be interesting to watch to see if this relationship kind of reasserts itself. But right now we're still dealing with interest rate or credit spreads that are extremely, I mean, historically low, certainly relative to the amount of mergers and acquisitions that are going on across the globe. And we'll finish on a couple of kind of topics of interest, and it's not worth going into all the minutia here, but clearly if you dissect the $1.9 trillion stimulus program, there's a lot of things that are getting fed here. It's a multi-headed hydra, as I'll call it. You've got stimulus checks, $411 billion that are going out to individuals, again, lower income individuals. You've got unemployment benefits, tax credit expansions for various things. You've got this aid to state and local governments, which it became a real political football. And, and I've got my own theories on that. Maybe a lot of jurisdictions that are receiving this aid actually have witnessed tax receipt increases. So, I'd argue that maybe a lot of this is not needed, but you can see that there's just a plethora of things that got served in this. Some of this was pork that was added to the bill, but clearly it's serving a lot of masters right now. And in this Harris poll, what I thought was really interesting is, the sentiment of when we come out of the pandemic, will there be a benefit, and will people perceive there being a benefit? And especially coming out of an extremely contentious election, I thought it was interesting to show this slide that, frankly, it kind of gives you hope that you've got a stronger understanding, kindness, compassion for others hold very high here, increased tolerance, more unity, charitable giving, social justice, and racial equality. Again, this is not a political statement. It's a Harris poll, so they were just, collecting data. But I thought, coming out of this pandemic, that these are things that, who wouldn't be happy to see some of these trends, perhaps, right? Removing some of the discord from our society. Just for interest's sake. All right, and last thing here is just the tourism. Now, the backdrop to this is actually what happened in basically in 9/11, which created the TSA. It did take travel in all forms a little while to pick back up. I mean, we saw this, so we have this case study in a microcosm that we can examine, and I think the same thing's going to play out here. And this particular survey seems to confirm that. So essentially, it's just going to take a while for our travel industry to kind of recover, dollar for dollar for what's been lost in the pandemic, and that's okay as long as we go into it with that expectation that we know it's going to take some time, and we don't have these these unfounded expectations that we're going to quickly and instantly recover this. Then I think we'll be okay. And I think the industry will adapt. It will adjust its capital spending plans accordingly, certainly its liquidity plans accordingly, and will be much better in the long run, and companies will be much more efficient in the long run as a result of it. Well, that's all we got today and for this week. In behalf of the entire team at BKA Wealth, we appreciate you taking the time and spending with us this week. We hope you've enjoyed the presentation. Appreciate any comments that you may have at the information you see here. Hope you have a safe week, a good week, and we'll talk to you again soon.